Coming up today, stocks attempt to bounce back. Are we following a similar path to 2020? Inflation comes in cooler than expected. Canada and the EU bite back. Mega cap tech to boost nuclear energy. And what the haters simply don't understand. It's going to be another good one, guys. Let's go. And welcome back, everybody, to Click Capital. On a bit of a continuation pattern from yesterday's trading session, getting a bit of a bump up in growth stocks again today. But we're actually getting a bit of a sharp pullback in defensive sectors, which I'll show you on the charts later on. Otherwise, still a bit checkered breadth. Market seemingly struggling to find a bit of direction so far this week. And once again, that hump day pattern playing out. Getting a little bit of a bump here on Wednesday after we had a really rough start again this week. Wednesday is the only positive day so far this year as we're quickly approaching the end of Q1. And so we've still got plenty of fear out there. Fear and greed index still in the extreme fear zone at 20. A lot of traders in the market at large still on edge. And in fact, just looking at data from Fundstrat, this 10% correction we've just had is in fact the fifth fastest of all time, with S&P pulling back 10% in just 20 days. And I was just saying yesterday how this price action was kind of eerily similar to that of COVID 2020. Reminded me a little bit of that, and the steady march down in price, along with volatility marching higher. And here's a chart of the current price action this year overlaid to the start of 2020. It was around that same period of time in March when things really took a nosedive. And there's a look at the heat map from March 16, 2020, right in the thick of it. You had to put on your sunglasses to look at it because the screen was so bright red that day across the board. However, things were a little different back then. That's why you can't just compare technical patterns one to the other. You got to put them within the context. Back then, we had a global pandemic with the global economy in the midst of being shut down for the first time in our lifetimes. Not surprising to see a bit of fear and liquidation in the market. But just looking back in modern day history of US stock returns after the market has declined 10% or more. And like I've always said, buying peak fear often comes with really good forward returns. In fact, the last 10% declines or more we've had in the market. 1 year later, the market's up on average 40%. 3 years, 76%. 5 years, more than a double. And so will this time be different? Is this the start of a new bear market or recession that so many people out there are convinced we're going into now? In fact, just looking at the MAG7 stocks and their forward PE here in the dark blue, currently now around 25, and the premium versus the rest of the S&P in the light blue, now down in the high 30s, which is actually the lowest we've seen since going back to about 2019. The premium of MAG7 stocks and their forward PE over the rest of the market. And something else a bit different we've seen this year, a huge outperformance of international stocks versus US stocks. All the US indices are negative year to date. However, European indices, even Asian indices, are higher year to date. In fact, that's the biggest relative return we've seen in over 30 years so far this year. And that's coincided with fund flows into US listed European equity ETFs, one of the highest we've seen since 2017. But just looking at a long-term chart of the Euro Stoxx 50 ETF listed in New York under ticker FEZ. This is kind of like the S&P 500 for Europe. And as you can see, unbelievably, where it stands today is still below the highs it reached back in 2007. I'm sure you've heard the term a lost decade. Well, for Europe's stock markets, it's been 2 lost decades. But anyway, looking back, the last time there was peak inflows in late 17 going into 18 here was right around this time. That proved to be a bit of a contrarian signal. Prior to that, we had peaks of fund flows into European equity ETFs back in 21. Around this time, again, was a bit of a contrarian signal. And prior to that, back in late 2013, going into 2014, there was a bit of an influx into European equity ETFs, which again was around this area here, proved to be a bit of a contrarian signal. Is this time different? European stocks have been on a pretty good march here the last couple of years now. A lot of investors, big and small, are piling into them. Many large institutional investors are bailing on US markets based on the new administration and the view that US stocks have gone too far for too long. We've also seen a tide of inflow into gold. In fact, Americans imported the most amount of gold bars in January, helping to throw the trade deficit out of whack and front-loading in front of tariffs. Saw a similar peak in 2020, and that too on gold was a little bit of a contrarian signal as gold did consolidate for a good 3 or so years there before we had a clean breakout early last year on a really strong march here, almost at the big psychological $3,000 an ounce level. So it'll be interesting to see how the shiny metal performs this year on the back of all those record imports. Are all those people right piling into gold up here? And so I suspect any further rallies in the stock market will be greeted with a wall of skepticism. Still plenty of headlines and rhetoric out there. Any rallies are a head fake. They're bound to roll over. The new president's destroying the economy, they're claiming. Or a trade war's going to add to record inflation. But we just got the latest inflation numbers, and as I've been thinking, came in a little cooler than expected on both the headline and core. And just looking at the hard data, it was actually the lowest print we've got in a year. And just going out 5 years, it is well and truly stabilizing here. In fact, going out 10 years, we're not that far off pre-COVID levels, really, in the high ones here. We're at 2.2. And just looking at the headline print as well, 2.8. We had hotter prints than that back in 2018. So for sure, I still think risks are more to the upside with inflation than downside with recession. However, we're just not seeing that here. And so why didn't the odds of a Fed rate cut improve for May? A lot of people seem confused about this one. Inflation came in better than expected, should open the door for the Fed to cut rates, right? Well, the market just increased the chances the Fed will stay on hold in May. We may get the cut in June. Even though, like I said, prices in the real economy are disinflating. Truflation got the US inflation index tracking at an annualized rate of 1.32. That's the lowest we've seen since inflation really kicked off in 2021. And bond yields bumped up across the curve as well, leaving a few people scratching their head. And so the way I interpret this is a few things. First, yields were already really weak coming into this CPI print, so it could have been a bit of a sell the rumor, buy the news. Plus, like I said, European markets are outperforming year to date, coinciding with weakness in the dollar, indicating large foreign investors could also be selling US bonds in addition to US stocks, which would help drive up yields. But just looking at the 10-year there, it's actually bounced already quite good over the last week, 431. So the way I see it, the markets are interpreting this cooler CPI that came in lower than expected on headline and core month over month and year over year, is looking through all that. The market might be pricing in expectations for stronger economic growth, or things aren't going to fall off a cliff, and that could be overwhelming. The need for the Fed to cut rates right away, hence the market pushing it out to June. And the market did sell off bonds today, finishing down, and like I said, in tandem with a bump up in growth assets today, outperforming again. Looking at the spread of high beta versus low volatility, up 2.7% today. On a day, CPI came in lower than expected, with bonds also selling off. That price action to me is the market saying this inflation print is good for growth assets. We won't be getting a Fed rate hike anytime soon. It's going to keep the cost of capital low. Bond yields not diving off a cliff, screaming at the Fed to cut. I think that's a good sign. And just looking at the price action in defensive sectors as well, coming off pretty hard here today, like they did yesterday. Healthcare down there a bit, along with consumer staples having quite a swift pullback here, down over 2% today, the weakest sector out there. So I think we could be seeing some green shoots on a potential end to this growth scare in the market, along with the VIX continuing to pull back as well, quite swiftly today, down to 24. And just an easy rule of thumb to work out what the average daily movement in the S&P 500, the VIX index, is predicting. You take the VIX index, currently 24.22, and divide that by 16. Gives us 1.51%. Is what the market's predicting the average daily movement up or down for the S&P 500 over the coming 30 days. That's still quite a lot, because like I said, the steamroller is still on the loose. We still have some backwardation in the volatility term structure. However, that's come down quite swiftly from Monday's sharp spike up there to 110. Here we are at 102. Also seen the price of out-of-the-money put options relative to at-the-money nosedive these last couple of days as well, to levels typically associated with bottoms in the market as well, as we've just had the risk event. The premium for that has been deflated. But like I said, we still are in the dicey zone here. You can see my market risk on off indicator still highlighting the chart red. S&P 500 oscillator did bounce back somewhat today, but still really oversold there at 35. But like I said, it was the Magnificent 7 leading the indices higher today, up over 2% collectively as a group. The other indices somewhat green, but still quite soft out there. So this market has yet to prove that it's formed a bottom. I've still got to give reasonable chance. We could have one last final flush out, give us that real capitulation. Because like I said, just looking at the VIX index, kind of been a march higher. We haven't really had that sharp spike like we got in August. Kind of been a bit of an orderly sell-off, even though it has been sharp and deep in growth names. And there's a look at the VIX from back in 2020. The market kind of already knew about what was happening in China. It was kind of ignoring it. Then it kind of really started breaking out around the world. And the market just woke up one day and went, oops, this is bad. Get the hell out. And it just kept marching and marching higher until we did hit that top in the VIX at around 85. Then we got a monster volatility crush in the months after that. However, like I said, the fundamentals are a lot different. This time, it's more on fears of what tariffs might do to the economy, not what they're actually doing, but rather what they might do, and that it could escalate into a nasty, prolonged global trade war. With Canada and the EU appearing to bite back, not willing to come to the table just yet for a major trade deal, although it is always an open invitation to do so, the European Union on Wednesday announced tariffs on $28 billion of imports from the US, including whiskey, beef, metals, and other products. Canada separately unveiled additional levies of its own, targeting more than $20 billion of US inputs. With the European Commission president saying, "We firmly believe that in a world fraught with geopolitical and economic uncertainties, it is not in our common interest to burden our economies with tariffs." But that statement just goes directly against their actions they just took targeting iconic American companies like Harley-Davidson, with the EU saying that on April 1 it will impose 50% tariffs on products including American motorcycle in retaliation for 25% tariffs on steel and aluminium. So it appears they're biting back when their economies are already struggling with growth. I don't think they have the leverage to win a trade war with the States. I think it's more not wanting to bow down right away to the new admin. And I mean, going after a company like Harley-Davidson, it's already been in the toilet for a number of years. In fact, just going out to a long 3-monthly chart, stock's been going sideways this entire century. Market cap of $3 billion. China, on the other hand, has bitten back, but only ever so softly, just to save face. I think they're a bit more concerned with losing their economic growth. They've been saying the right things, like they're willing to cooperate with the US on fentanyl, but until it stops actually pouring into the country via Mexico, I guess it's just that, talk. But these economies know they're playing with fire here. We've seen it in Europe, we just saw it again today in Canada. Bank of Canada cutting its main interest rate by a quarter point to help offset weaker consumer spending and business investment stemming from trade policy uncertainty. With the governor saying we're now facing a new crisis. Also mentioning that rate policy cannot offset the impacts of a trade war. Still think it's in everyone's best interests to get a big trade deal done, hopefully this year. It will be better for these economies. They've just got to meet the states in the middle and not tariff their products as much as the states tariff them. And moving on to everybody's favorite stock, Tesla. Elon Musk saying they're going to double US vehicle output within the next 2 years, at a time they're currently under attack from a certain faction of the country trying to bring them down. And it's funny because those same group of people, prior to Trump getting in, shared a very strong ideology about climate change and the importance of getting away from fossil fuels. However, like I said, their hate for Trump, which now extends to Musk because he's partnered with them, overrides any previous ideology they had or actual care for the environment. But those that can look past that BS can see the opportunity, including Morgan Stanley, just coming out a couple of days ago, given a sky-high bull case scenario of $800 a share. We were just trading down to $220 yesterday. And just zooming in here on their research note, and I agree with this analyst. Having covered Tesla for nearly 15 years, we find that the investor narrative around the company tends to follow the share price. In December, with the stock testing $500 a share, the prevailing sentiment was that the company is an AI winner with untapped exposure to embodied AI expressions such as humanoid robotics. Today, with the stock down 50%, our investor conversations are focused on management distraction, brand degradation, and lost auto sales, and citing the catalysts that I often mention for their bull case: Robotaxi, Optimus Bot. And what I'm seeing a lot of throughout my social media feed is more and more people coming out in support of Tesla, saying they're going to buy a new Tesla EV. And so for every lunatic and Karen out there hating on it, there's guys like this that are stepping up to support them. And in fact, just looking at Google search volumes for the search term buy a Tesla, it's currently sitting at an all-time high. On the back of Trump buying one yesterday, is encouraging a lot of people out there to come out in support of Tesla and go against all the lunatics who previously believed in climate change, who are now trying to destroy the company, along with the mainstream media, who would also love to see the company get destroyed, with headline after headline why you should keep selling your shares for the simple reason of political noise. And I actually agree with them. It's just that, noise. And I agree with former Treasury Secretary Stephen Mnuchin. People are overreacting a bit to Trump's policy. He doesn't see any signs of an imminent slowdown for the US economy and believes this is just all headlines and rhetoric. Doesn't think we're going to have a recession, but of course there's plenty of fodder for the media to play with over all this tariff stuff. Personally, I think it's been blown out of proportion, but that's the markets for you. Crowd psychology is a funny thing. People can often do more stupid things in a crowd than they would by themselves. And the same people that were previously backing Tesla also called for wasteful government spending to be dialed in. They just don't like who's doing it now. And just looking at the popular website, usdebtclock.org, it's been around for a long time. They've just added a new section, the Doge Clock, from the Department of Government Efficiency, real-time savings. New admin hasn't been in power for not even 2 months and have saved US taxpayers almost $200 billion so far. That's over $1,700 in savings per taxpayer, and they're just getting started. So who would have thought a few years ago we'd be seeing this, just after the previous admin completely snubbed Tesla, even though it's the most all-American made car. They didn't want to acknowledge Tesla or Elon Musk, and that probably just helped to where we stand today, with Tesla now got a front row seat at the White House. And so in my opinion, what the haters will never understand is the more they hate Tesla, the more they hate Elon Musk, the more they try and bring them down, the more likely Tesla will succeed. The more it just motivates Musk to prove them all wrong. And this is something I've seen over the last 15 years. And why I truly believe Tesla is bound to be the largest company in the world. And it looks like the market is liking all this today. Pretty strong bounce here for the stock, 7.5%. I was fortunate enough to buy the dip yesterday at 220. I would love another chance at 188 if we get there in the coming weeks. Otherwise, no doubt this is going to continue to be volatile up and down. Just like NVDA had a pretty good bounce there today, 6.4%. Good to see these stocks stocks having a strong bounce here. It was also good to see Amazon, Meta, and Google signing a World Nuclear Association pledge, aiming to triple the global nuclear power supply by 2050. These companies' electricity requirements to run their data centers are now rivaling that of small countries. They need huge amounts of electricity, and nuclear is the best source of that. So they are pretty much all in on nuclear power, and I still don't think the market has fully appreciated this yet. And I believe in a lot of uranium nuclear stocks, both at the miners level and everything to distribution. This huge influx of investment and usage, I don't think it's been completely discounted in my opinion. And uranium too, I believe, is at good levels here and likely to bounce back and continue to be a good investment going forward, with some of the biggest uranium miners still down quite a bit off their highs, along with others like NuScale as well, with small modular reactors. And just moving on, looking at some other charts, we've still got a bit of weakness in the retail sector. Obviously worried about the impact of potential tariffs on Mexico and China. Looking quite oversold here today, along with jets as well. Some weak guidance coming out of American Airlines, and financials have also been pulling back, while energy stocks have actually bounced up this last week as crude continues to appear to be finding support around this big level, $67 a barrel. And Bitcoin as well, trying to find its feet here. Still not really a convincing bottom here. High yield bonds have pulled back a bit over this last week, and breadth percentage of stocks above the 20-day average. 18%, we can get a bit lower than that before the market can typically find a bottom. And just looking at the Qs and Russell 2000, it's kind of stalling and grinding here, like it's trying to find a bottom, but I'm still not 100% convinced yet. Till we get the volatility term structure back into contango, like I said, the steamroller is still on the loose. Should expect big whips up and down, but I think we'll know we've hit the bottom in addition to the volatility term structure when we get that monster green candle of a day. Bullish breadth across the board on huge volume, which will be short covering, and that should be led by the high beta growth names. Then it'll be safe to say that we've likely seen the worst of it. Otherwise, for now, the market's still on notice, and we'll just have to wait and see what the last two trading sessions bring us. We've got PPI tomorrow and consumer sentiment on Friday. But like I said, pretty good price action and bond yields on the back of CPI today, suggesting they think economic growth isn't about to fall off a cliff as the headlines would suggest. That's all I got for you today. Thanks very much for tuning in, and I'll see you back here again this time tomorrow. Cheers.